The market is bombarded by headlines around Russia and Ukraine. Needless to say, any kind of economic conflict can affect how the stock market performs. Risk assets such as stocks are tumbling. Traditional safe havens like treasury debt and gold are rising. And oil and other key commodities are spiking at a time when the US inflation just hit a 4-decade high. As an investor, you must be on edge, thinking, what should I do? We'll answer all these questions with today's topic. Hey, welcome to Stock Market Mate. Today, we'll talk about the Russia-Ukraine conflicts and how it affects the stock market. We'll also talk about the best and worst stocks to buy during these times, and what you should remember during times of conflict. Before we start, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Looking back in history, it's helpful to take a look back into historical conflicts to see how the market performed in the past. A journalist from Bloomberg used a specific table to track the S&P 500 for 1 month, 3 months, 6 and 12 after a significant military event. It began with Pearl Harbor in 1941 and down to 2003, during the war in Iraq. But what's incredibly striking is the average response to these events. They're generally positive. In fact, out of all those events, only 3 of them have negatively impacted the market in a 12-month period. They're the Suez Canal crisis, the Arab oil embargo, and 9/11. In 2015, researchers at the Swiss Finance Institute looked at U.S. military conflicts after World War II. They found that in cases where there is a pre-war phase, an increase in the war likelihood tends to decrease stock prices. However, the ultimate outbreak of a war increases them. In cases when a war starts as a surprise, the outbreak of a war decreases stock prices. They call this phenomenon the war puzzle, and said there's no clear explanation why stocks increase significantly once war breaks out after a prelude. So what should you do? The Russian equity market peaked in October 2021. If we try to track single-country exchange-traded funds, you can see that it's the very same country that has fallen the most in these times. As of now, the Russian equity falls around 30%. But if the conflict escalates to a very serious war, volatility can be expected to heavily affect equity markets. Looking at history, we can predict what could happen to markets if the situation escalates. But as disastrous and disorienting as the impact of Europe's largest military conflict since World War II might be, the best course of action for most retail investors is to keep calm and carry on. Simply, don't panic. For one thing, selling into a falling market is the opposite of what successful investors do. The idea is to buy low after all. Equally important is the fact that no one knows what Russia's invasion of Ukraine ultimately means for everything, from energy prices to monetary policy. And then there's the case that, historically speaking, stocks tend to recover quickly after being derailed by international turmoil. So these are the stocks to avoid during armed conflicts. Some stocks perform better than others, especially in times of war. In February, investors got a glimpse at which stocks may be hit hardest if the global conflict in Ukraine escalates further. Travel and leisure stocks were among the worst performers in the S&P 500 in morning trade. This includes online travel stock Expedia Group Incorporated, casino operator Las Vegas Sands Corporated, and airline stock United Airlines Holdings Incorporated. In addition to travel stocks, bank stocks also took a big hit in the Ukraine news. Some experts speculate that the uncertainty of the Ukraine conflict, paired with the stock market volatility, has triggered the Federal Reserve to be more conservative in raising interest rates to combat inflation. Bank stocks that benefit from higher interest rates have suffered in this crisis. Stocks like Fifth Third Bancorp, Signature Bank, and Wells Fargo and Company were among the worst performers in the S&P 500, so it's best to avoid investing in these. Now let's talk about the best stocks to buy during armed conflict. Every good investor must know their game. Simply, you should know which stocks will give you the best returns. But of course, before you pour in the money, economic circumstances must also be taken into account. Now with the issues surrounding Ukraine and Russia, what stocks should you look into? Amid the current conflicts between the two countries, defense stocks have outperformed. Wall Street even expects this trend to continue for some time. But honestly, it's no surprise that defense stocks have performed relatively well since the conflict broke out. L3Harris Technologies Incorporated, a military electronic technology company, gained more than 4% since the conflict erupted. Shares of defense contractor Northrop Grumman also traded higher by more than 2%. Defense and cybersecurity stocks are seeing a sharp rise in values as investors take notes of pledges by the EU to boost defense spending. Governments warn of an increased threat to cyber intrusions following Russia's invasion of Ukraine. In addition to defense stocks, rising energy prices around the world have been a tailwind for the energy sector. In fact, 11 of the 12 best-performing stocks in the S&P 500 are oil and gas stocks. Oil shot above $100 per barrel for the first time in years, the day Russia invaded Ukraine, and has climbed sharply higher since. It's a great time to take advantage of the situation and earn from it. Stocks from ExxonMobil, Devon, ConocoPhillips, and Phillips 66 are one of the best ones that should not be overlooked. But most certainly, you should look into Valero Energy. This is a major player in the market for refined oil products. In fact, Valero is the world's largest independent petroleum refiner and the second largest producer of renewable fuels. While political pressures are pushing the industry toward renewable fuel products, Valero's strong position in that market provides the company with a degree of protection from pricing pressures. To sum it up, the stocks that are doing well during the war between Ukraine and Russia are defense stocks, cybersecurity stocks, and oil and gas stocks. Of course, before you make any drastic decisions, do make your own research. Also, remember that when you're investing, your focus should always be on the underlying business. If you're focusing on the microeconomy or the news at the time, you will always find a reason not to buy. So with this Russia and Ukraine crisis, you need to ask yourself whether this event will significantly impact the long-term earning power of the businesses that you invest in. As famous hedge fund manager Peter Lynch says, the focus always needs to be on the business. As a smart investor, remember to buy high-quality businesses at fair prices and hold them long-term. Now, what will be the future of the stock market? The S&P 500 initially dropped more than 2% on the morning of February 24th. If history is an indication, the Russia-Ukraine sell-off may prove to be short-lived. In fact, most geopolitical events are sharp but short-lived, with volatility creating opportunity. Since 1941, the S&P 500 has averaged a total drawdown of 5%, following 21 major geopolitical events, including the Pearl Harbor attack, the assassination of President John F. Kennedy, and the September 11 terrorist attacks. Despite the initial market volatility, the S&P 500 has subsequently taken an average of only 45 days to fully recover those initial losses. Bill Adams, chief economist for Comerica Bank, says higher energy prices may be a modest headwind for U.S. economic growth in 2022. U.S. growth this year should be supported by less drag from the pandemic and consumers dipping into the $2+ trillion in savings that they accumulated since the start of the pandemic. These factors will likely matter more for the U.S. economy than the Russia-Ukraine conflict. So, bottom line, geopolitics rattling markets is nothing new. Over the last few years, markets have been conditioned not to overreact to political and geopolitical shocks for two reasons. First, the belief that there would be no significant subsequent intensification of the initial shock. And second, that central banks stood ready and able to repress financial volatility. The impact of these events tend to be short-lived. As devastating as a major conflict could be between Russia and Ukraine, the truth is, stocks likely will be able to withstand the geopolitical struggle. While there may be some additional volatility in the short term, these disturbances historically present opportunities, as long as a recession doesn't follow. You may feel unsteady, and there must be an unexplained urge to make precautionary measures. However, keep your actions to a minimum. Think about earning along the way, but don't go all out since the circumstances surrounding Russia and Ukraine tend to be uncertain. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!